Welcome to our today's feature presentation, Natural and Mathematical Trading Models. What you will learn in this unit is how the natural behavior of supply and demand can be portrayed when you use the right model. However, most of the retail traders are using inferior linear mathematical models and with that have a very hard time predicting the future. And I want to invite you to learn how you can do that and how our algorithmic systems and vector graphics help to portray the details of a price move on the chart so that you can see and spot and follow it with high predictability. My name is Thomas Barman. I want to make you aware of the risk of trading and that past performance cannot always be taken indicative for future results. And with that, let us get into the details. Our brains are wired to detect patterns, and we are taught and think in linear relationship. Hence, we connect data points with lines and channels regardless nowadays of the validity of the data correlation. However, how is the real nature going? Yeah, now I took here a riverbed. Real nature is not in any way or fashion giving a clear-cut linear relationship between point A and B, and thus a different instrument or a different type of math is needed to calculate the flow of the river and the happening. And I will go more into detail with you. As a consequence, you need a model that helps you to frame the natural happening, giving you an idea of how prices develop and why. And so this is what we're doing with our never loss trading models. Yeah, we'll give you a clear-cut idea of how prices develop and why. And I'll give you examples today, and you will see how a different math and a different model can help you to explain the natural happening with high predictability. This is how most of you see the charts. Yeah, candlesticks, patterns. What you have here is Amazon on a daily chart. And we have here January 3, the first trading day, and we want to portray the future within using different models and see how we can predict the price move of an underlying asset. Yeah, so the very basic and most simple method would be we'll make a little channel model on it here. So we hit it here. And so if we connect the 2 or 3 points like we did here, so our assumption at the beginning was, okay, channel might be going like this, yeah, all the way up there. But you see already here, we didn't get the direction right because we estimated so that the price is gonna go up. However, it went sideways and then afterwards found its initiation point. So you might say, yeah, not a problem. We'll take a new approach. Nothing easier than that. We'll connect now the new data points that we found. And so we assume that's our trading channel. However, did that hold true? And do prices really follow those channel developments? Again, here, the price prediction with the linear graph didn't work. Yeah, because the price made so it's I'm saying totally different. So do you want to now go ahead and reconnect the channels again, or you see what we are telling you here, it makes no sense to do it this way. This will not give you the high predictability that you want and need to be a successful trader. On the first approach, what we did here, we colored the candles with our trade colors model, which is the basis of all our models, and also that is available as a standalone trading platform. And you trade when two of the same directional color combinations work. So that you already have a trading model. Yeah, no more that you scale out here a trend. You would know, okay, at that point, there is a trading opportunity, and all of those colored in blue, they belong to an upside opportunity. Their potential downside, yeah, but here again, and all of them that come after belong to an upside opportunity. And then basically here we got a very short-term short opportunity that realized in the next candle. And this is where we sit right now when I do this recording at 3.8. Do you see the difference? How would you have known from the charts you are trading from most likely today that there was an initiation of an uptrend and there was an initiation of an uptrend and that was a potential short-term downtrend, and where to set your stops, where to put your entry trigger, and how to do all that. Yeah, so because the entry trigger for us would be above that price threshold. We also define specifically where the stop goes, and you see those would have led to very nice, good trading opportunities where from the get-go we scale out how far a price move shall be and how many candles should be involved until we assume a little bit of a retracement. But taking it very simple. So you see already by coloring the candles differently, we are having a trading plan right on the chart that you can spot and follow the money moves that are of the underlying. Back to the trade color model. Here you already see how things are changing, how you understand for what's in an uptrend, where is trade initiation, and where you have a potential to participate in the underlying price move. In the next step, we're adding what's called the never lost trading box. Yeah, this gray box, gray frame on the chart. And so it shows you here, for example, that was a price containment spun by that candle. And you see, oh yeah, when prices are moving out of this, they have a certain tendency to move up and down. And you're already there to understand and find a natural potential of a price move. Yeah, let me take all my drawings here away and guide you through again where we jointly look. Is it okay? You see here there's a price containment, for example, but when that containment was broke, a price move to what? The upside happened. Yeah, and there was a price containment here, and it immediately got broke, and then we moved up until a new price containment happened. And what did the price do here? So it tested the containment until it broke out. Yeah, and the same we did here. It made a price containment area, volatility bracket, what we call the never lost trading box. And when it started to break out, it went up again. So you see when you understand that even with these square boxes, we have much more indicators, more telling when these breakouts and things happen, how you have an idea where prices will go. And this is also when you see for Amazon, where are we right now? So predictability. So we so far don't break down with the price until we'll break that containment area, and then we'll see what kind of a new bracket we make either to the downside or we'll go and we'll make a new bracket to the upside, highlighting a new price area and a new price containment area. What we added now is our speed unit box here to the chart, and it gives you bar by bar an idea when those breakouts happen for how far they shall last until they halter. Yes, so you get an idea, okay, when the price breaks out at the last bar, that's the measure right now, then I can expect a $9.34 price move, and it will be a 1.1% uh, overall return on cash. And the trend currently measured is potentially down. That's a different measurement, not so important for your trading for right now. That's how that needs to be explained further. But this would be your key measures. You look for your SPOO and you look for your potential return. But you also can naturally can trade an option, and then you know how much will the price contribute by the delta. And in our program, we'll show you which delta you best buy to get the highest ability out of the trade and the best ability to repair a trade in case it goes wrong. We hope you can agree with us that so much more easy you can now see, okay, what's happening and how does it happen and when you can act. Yeah. And how far it will reach. Yeah? So if you trade it here on a potential price breakout, you know it's going to last for that many dollars to the upside. And you will be wrong when your downside here is taken out because that will devalidate the trade direction. So what can you do? You either take your stop or you take protective measures. What we did now is we added the never lost trading trend catching indicator. So it helps you finding multiple entries within the price development of an underlying and giving you the opportunities. And what we do now is we take good trade and bad trade together because nothing works 100%, but we want to show you what high probability means on an actual example. Yes. So first trade initiated here. So you saw here. Okay. Yeah. So there was a trade. And was the winner or loser? Said, okay, it expands about that far. It did halter there, exactly. So you made your first good bite out of it, and you had a winner. Second trade, yeah, and it told you when it comes to here on pricing, price might holder, did it do that? Absolutely. So you have winner number 2. Yeah, so then this one didn't realize. Then there is what? Winner number 3. Yeah, said its minimum goes here, went a little higher, so that's nothing to complain over. Winner number 3. If you took this one, you would be stopped here. So here we put out. So this one would be a loser. But what is it telling you? 1, 2, 3 winners, 1 loser. That's already a 75% attainment rate. This trade didn't come forward because we only trade when the formulated price threshold is taken out in the next candle. So it was sell below 809.56. Next candle was lower. Next candle here wasn't higher. No trade, no trade, no trade. There we go. Next trading opportunity. Right here, where did it say it should stop? Yeah, right above here. So we have 4 winning trades in a row, and then that continues here with this candle and this candle, giving you trade number 5, trade number 6 with a clear cut exit here, and then there is no trade here. That's just a sign that there was the temporary high of Amazon. So what do you count up? We have 6 positive trades in the price development of the underlying, and we had 1 losing trade. That's what we call high probability trading. And you see, this is just a very little introduction video of what is all possible if you follow the natural model of supply and demand with a meaningful mathematical model and vector graphics that portray the happening on the chart for you to spot and follow. You can learn all this and a lot more in our mentorships. We only teach one-on-one. Yeah, so that means we have no classroom with 30, 40, 50 people. We teach one-on-one, focused on your wants and needs. We help to install, no, we install the software. It's on a server. So therefore you buy a new computer or you sign in from a third-party computer. All your settings are there. Data is real-time without fees. That's very important too. You always know your entry, exit, stop. You saw from the chart of how that works. We have position sizing models that help you based on a setup for saying, okay, how much risk would be apropos for that individual trade situation, or how much can I make out of this and put that in relation. Then how long am I supposed to be in a trade? How do I handle risk? And in particular drawdowns, and we make a business plan with you where you experience a financial plan. Yeah, what should trading returns be for you? And in addition, an action plan. How do you act when things go wrong? How do you act in preparation of your charts? And you get all of these taught in mentorships at your best available times and at your best available days. Even we include weekends. Yeah. So if you want to be part of this, call us 866-455-4520 or contact at neverlosstrading.com, and we are looking forward helping you changing your trading future. And we are looking forward hearing back from you. Bye-bye.